When a stock market experiences a crash, it is the effect of economic events spurring investors to act out of fear. Such financial crises have occurred frequently throughout history. In the United States, stock market crashes were already documented in the 18th century, and significant financial crises have existed in the US history ever since. Let's start simple. What even are stock market crashes? A stock market crash is a sudden and significant drop in the price of a stock or many stocks. Stock market crashes are often the result of several economic factors, such as speculation, panic selling, or bubbles, and can also occur in the wake of an economic crisis or major disaster. While there are no official criteria for a stock market crash, a common criterion is a sharp double-digit drop in a stock index, such as the Standard & Poor's 500 index or the Dow Jones Industrial Average, over a period of several days. There are measures in place to help prevent a stock market crash, such as trading curbs or circuit breakers that can halt any trading activity for a specific period following a sudden decline in stock prices. Let's look at some of the earliest recorded US stock market crashes. The first US stock market crash occurred in March 1792. Prior to the financial crisis of 1791 to 1792, US banks overextended credit creation, leading to a speculative rise in the securities market. Treasury Secretary Alexander Hamilton persuaded many banks to grant discounts to those who needed credit in several cities. He also used numerous policies and other measures to stabilize the US market. The initial Wall Street crash lasted only a month or so, but was followed by a series of panics throughout the 19th and early 20th centuries. In the United States, these include the Panic of 1819, America's first Great Depression, sparked by the collapse of cotton prices with credit contraction and over-speculation in land, commodities, and stocks, which came to an end in 1821. Panic of 1837, the main cause of this panic were the real estate bubble and the unstable banking policies of the United States. Then, President Andrew Jackson refused to extend the license of the Second Bank of the United States, allowing state banks to issue banknotes recklessly. This led to a major economic depression, which lasted 6 years. Panic of 1857, the collapse of the Ohio Life Insurance and Trust Company, led to restrictions on transactions put by New York banks, which in turn led to panic selling. This was followed by banks closing, and the depression lasted for 3 years. Panic of 1884. The panic was triggered by the failure of a small number of New York City financial institutions led by the Metropolitan National Bank. Although the closure of the Metropolitan National Bank caused public concerns about banks and its network, the crisis was mostly confined to New York City and was quickly contained. Panic of 1893. During a run on gold in the US Treasury and slowed economic activity, unemployment skyrocketed, asset prices fell to the ground, and panic selling ensued, which caused one of the most severe depressions in the US history. Panic of 1896. This was a continuation of the Panic of 1893, followed by a brief pause before the US economy fell into another recession in late 1895. It wouldn't recover until mid-1897. Panic of 1901. This panic was caused in large part by a dispute between Jacob Schiff, J.P. Morgan, James Hill, and E.H. Harriman over the Northern Pacific Railway. As the price of the Northern Pacific soared, short sellers flooded the market, causing stocks and bonds to fall sharply. The Panic of 1901 ended with a truce between the financial giants. Panic of 1907. This was the first financial crisis of the 20th century, which sparked the monetary reform movement that led to the creation of the Federal Reserve System, FRS, commonly referred to as the Fed. Following a failed attempt by Augustus Hines and Charles Morris to corner the stocks of United Copper, several banks associated with the two men succumbed to runs by depositors. This led to additional runs on numerous trust companies, which resulted in a severe reduction in market liquidity. If not for the intervention of JP Morgan, the New York Stock Exchange might have very well closed. I'm going to end this video with the story of Black Friday. On September 24, 1869, the gold market collapsed after two speculators, Jay Gould and Jim Fisk, devised a plan to inflate the price of gold. The pair also hired Abel Rathbone Corbin to convince President Ulysses Grant to further restrict access to gold, which made their plan a success. In response, President Grant ordered the sale of $4 million worth of government gold bullion. Gould and Fisk managed to raise the price of gold, but when government-issued gold bullion hit the market, panic set in and the price of gold plummeted. Investors desperately tried to sell their holdings, but many investors financed their purchases with loans, and as a result, they no longer had the money to pay back their debts. That's it for this video, guys. Hope you guys enjoyed the video. If you do want to see more of this content, please like, comment, subscribe, and even turn on the bell notification icon. See you all in the next video.